Friends, in this video for I Thought Wealth, I am going to talk to you on the topic, will the markets see sectoral rotation? Over the last 2 years, right from the time COVID struck, we have seen the markets bet on defensives. The market was unwilling to bet on cyclicals. The reason was, for the first time post liberalization, we had a year of sharp negative economic growth, and then we had economic growth only to the extent that we would regain the growth we lost. Effectively, we were forced to buy businesses which did not degrow at much higher valuations than we normally would, because institutional investors had to put the money somewhere. So those who were already owning these defensive businesses turned out to be better performers in the eyes of the public. Their NAVs moved more than the benchmarks, and as a result, more money came to them. This doesn't apply only to the mutual fund side, it also applies to the PMS side. Subsequently, the defensive trade is slowly winding down, and you are seeing that those fund managers who performed exceptionally in 2020 did not do as well in 21, and they are probably doing badly now. Going forward, what will happen? Will they recover, and will defensives bring them back to their past glory of 2020, or do they have to wait for a long while before they can start doing better, or will they go down further before they come up? My sense is, we are seeing inflation in commodities, in inputs after a very long time, and this inflation is not going to come down anytime soon. Globally, we are going to see an inflationary era after a very long gap, and in India too, we are seeing an inflationary era after a decade. Most investors who are very active in the market today have not seen an inflationary era. Even managers were probably in school when the last inflationary era happened. So, everybody thinks that we don't have a choice to deploy money, therefore defensive valuations need not go down. But knowing how defensives behave during inflationary times, we could well see that they will struggle to grow, they could see degrowth in parts, and the profits will start contracting a bit. Even that small contraction in profits and marginal contraction in growth will rattle institutional investors who were wired to not expect any disappointments. So, in that sense, most of the institutional money will become cautious and wary of a change in the trends in defensives. As a result, they would want to buy something else which will deliver performance for them, so that they don't look weak before their benchmarks. That is a compulsion for institutional investors. As a result of it, even institutional investors who gave yarn on defensives and how India has only a few stocks to buy, and these are going to come down from that Warren Buffett perch and buy some businesses which will help them generate beta. When that happens, impact cost in defensives is bound to rise. Also, retail investors who have done sidecar investing on these institutional investors are going to lose patience, because their stocks are either going down a bit or not going anywhere. They have already waited a few years to see performance, and they know clearly that it is going to take a few more years. It doesn't make sense for them to wait for years together when other stocks are moving up. So, money is bound to move from sidecar investors into other areas. So, sectoral rotation is bound to happen now. Why is it not happening as actively as the economic fundamentals are changing? People are still hoping that some miracle will happen. They are still hoping that inflation will come down very quickly. They are still hoping that others won't sell, and everybody is looking at everybody else to see if somebody is selling. but selling doesn't happen with warning. So, whenever it happens, it will be unwarned and it will come with high impact, and when that happens, rotation will happen because a lot of investors are going to chicken out of waiting trades. Sectoral rotation is not because people have high conviction. It is not going to happen because people want to be in the place with the highest conviction. We all know institutional investors want to be in a place where there is scope to earn some beta. Wherever price is moving up and they see certainty of earnings, they will put some money there so that they are not caught left out. Remember all these guys who avoided Reliance in 2020, and remember how they were put through pain right through that year. I don't think institutional investors will want to see the same thing happening to them in commodities now and in cyclicals. They will be forced to buy some amount of these stocks also, so that they are not left caught napping, because for many institutional investors it could even mean a loss of face and jobs. So, that is a risk which most people won't take. So, sectoral rotation is a reality which will start after this quarter's results and after the management commentary. There was a lot of volatility before the Ukraine war started, and there has been a lot of volatility of a very different nature during the Ukraine war. Now, the institutional investors will try to reset their expectations to a post-Ukraine scenario in sectoral trades, in cyclical trades, and then they will allot money to these trades so that they are not caught completely left out of these trades. When that happens, retail will also follow, because somebody who is a sidecar to an institution will always follow that institutional investor. They are not going to run ahead of them, because they have been made to believe that these voices represent the voices of the entire investor community. For that, we have our mainstream media to blame, because they have overexposed a certain way of thinking to investors and played it so many times that investors believe that that is gospel truth. But experience has taught us that there is no gospel truth in investing. Truth is what we see as the immediate future, and that is how markets always behave, and that is how markets will behave this time too. Thank you for watching this video.